Welcome to this deep dive. Our focus today is cutting through the noise surrounding the Q2 2025 earnings call for Gulf Island Fabrication, Inc. That's ticker symbol GIFI.
Right.
These results hit the wire after the market closed back on August 6th, and, well, they really provide a compelling case study in corporate transformation, I think.
Yeah, absolutely. Yeah. The immediate takeaway, this quarter was a perfect setup for what Wall Street often calls, near-term pain.
Yeah.
Running straight into long-term potential.
Okay.
GIFI missed the headline numbers, and they missed them pretty decisively. But the entire narrative was defined by the integration of their recent, really crucial acquisition. So for you, the listener, the mission here is deciding, do you obsess over this bump in the road, or do you recognize the new, maybe more durable road they're attempting to pave here?
Let's start with that immediate bump then. The top-line numbers were, well, soft. Consolidated revenue clocked in at $37.5 million.
Right.
That was a slight miss versus street expectations, and it marks a 9% year-over-year decline.
Yeah, not insignificant. But the real shock, I'd say, was the bottom line. GIFI reported a GAAP loss of $0.04 per share.
Wow. Okay. A lot.
Exactly. That is a definitive miss, sitting nearly 10 cents below the consensus estimates, which, were centered on a profit between maybe $1.05 and 6 cents.
Big difference.
Huge. And you can trace that gap almost entirely to the costs associated with their new strategic direction.
So given the magnitude of that earnings miss, the market reaction was surprisingly maybe modest. Shares dipped only slightly after hours. Why wasn't there more panic?
Well, I think it comes down to adjusted EBITDA. Despite the clear revenue weakness and those initial integration costs we just mentioned, the company reported $1.9 million in adjusted EBITDA.
Okay. Still positive there.
Still positive. Now, I want to be clear. That figure is down 25% from $2.5 million the prior year. It's not a small dip.
Right.
But relative to the GAAP loss and that acquisition drag, it signals some serious operational cost discipline. It seems the market focused on the fact that the core business remains, fundamentally profitable, even while it absorbs this major strategic hit.
That's fair, but let's dig into where the softness actually originated. If we look at the legacy segmented results, we can see the pressure points pretty clearly.
Yeah.
In the services division, which handles things like offshore maintenance, revenue fell 3.5% year over year to $22 million.
And that services pressure is directly related to the general cycle of the oil and gas market, I think. Offshore maintenance activity is just lower, probably tied to sustained low natural gas prices, general industry uncertainty. It makes clients push back non-essential maintenance, sort of confirms the wisdom of their pivot strategy, actually.
Right. Segment EBITDA, there was $2.0 million, still strong, but declining.
Declining, yeah.
Now, the fabrication division, that's their large project division, it took a much harder hit. Revenue there tumbled 15% year over year to $15.8 million.
Ouch. Yeah, management explicitly cited extended project award decisions and reduced facility utilization. Their facility capacity is kind of sitting idle, essentially waiting for those huge energy projects that, well, they don't seem to materialize quickly anymore.
So that's the key operational reality, project hesitancy.
Exactly. The fabrication segment EBITDA came in lower at $1.1 million. So the legacy business is undeniably soft. It confirms the need for this strategic pivot, definitely.
But it also raises the question, are those soft numbers hiding maybe a greater reluctance from potential clients? Are they worried about the integration risk itself?
That's a fair question. The challenge of absorbing these short-term segment hits and, massive integration costs can absolutely cripple a company. But GIFI is, well, insulated. And that brings us to their impressive liquidity.
The balance sheet, right.
That balance sheet strength is just critical to surviving the, $2 million in losses they've guided for the second half? GIFI ended the quarter with $62.2 million in cash and short-term investments.
Okay, that's a solid cushion.
It really is.
Yeah.
Compare that to their debt position. A very modest $19 million of fixed-rate debt locked in at a low 3.0% interest rate. They are essentially operating from a position of deep financial strength.
And management certainly didn't seem shy about it. They actively signaled confidence, didn't they, repurchasing shares?
They did. They bought back approximately 437,000 shares for $2.8 million, average price of $6.41 during the quarter.
So putting money where their mouth is, even with the disappointment on the Q2 bottom line.
Precisely. Now, we need to analyze the reason for, well, the whole mess. The ENGlobal acquisition. This purchase of automation engineering and government services assets closed during Q2.
Okay.
The idea is to fundamentally change GIFI's margin profile and end market exposure. moving them into things like data centers, stable government contracts, and creating turnkey fabrication solutions.
And that strategic push came at an immediate measurable cost. That's what directly led to the $4 GAAP loss, right?
Exactly right. The Q2 financials included $1.8 million in non-recurring transaction and related costs tied directly to the acquisition. Plus, we saw immediate post-acquisition operating losses of about $500,000 split across the segments. That whole $2.3 million hit is basically the investment they're making up front to fundamentally change their business.
Let's talk about that change for a second. Why is acquiring automation and engineering services so critical? Isn't fabrication just about, welding and moving steel?
Well, it was, maybe, but it can't be anymore, not if you want better margins and less cyclicality. By acquiring ENGlobal, GIFI is trying to move from being just a low-margin fabricator of someone else's design to becoming a higher-margin turnkey solutions provider. They now own the engineering, the automation IP. It means they can bid on projects that require integrated design-build solutions.
So it reduces the customer's reliance on maybe outside engineering firms.
Exactly. It makes the acquired revenue potentially more durable, higher margin, transforming them from a pure cyclical industrial player into something more like a resilient technology-enabled service platform.
Okay, that makes sense. But that repositioning is going to be tested by their guidance. Management is essentially telling the market to, brace for more operational drag in the near term.
They absolutely are. Management expects Q3 consolidated results, and this excluding the ENGlobal losses, to be comparable to Q2.
So flatlining before the acquisition impact.
Pretty much. But here is the critical near-term hurdle.
Yeah.
The ENGlobal unit itself is projected to incur operating losses of approximately $1.5 million to $2.0 million across the entire back half of 2025.
Okay, that's the expected cost of stabilization then.
That's the number they put out there.
So we have two potentially tough quarters ahead, Q3 being maybe the choppiest. But where is the inflection point? When does this turn around?
Well, management flagged an expectation for, and they used the word significant improvement, in Q4 and heading into 2026.
Okay.
Driven by integration progress and hopefully new project cycles kicking in, they are very clear. ENGlobal is targeted for profitability sometime in 2026. That timeline is the map the market is betting on, I think.
And we did see some immediate proof of improved bidding activity right in the Q2 call. That felt like a good strategic sign. They announced receiving a limited notice to proceed, an LNTP, for a structural steel project valued at approximately $20 million.
Yes, and for anyone unfamiliar, an LNTP is essentially a strong handshake agreement.
Yep.
It lets them start preliminary engineering design work, crucial procurement immediately, signals real confidence.
So the full $35 million contract is expected when? Q3.
Expected in Q3, with fabrication commencing in Q4 2025. This shows their sales cycle is starting to thaw, kind of right on schedule with their narrative.
What's fascinating here, I thought, is how this project connects to the macro environment. Management highlighted several market tailwinds, LNG, petrochemicals.
The usual suspects for them, yeah.
But they also emphasized the broader push for U.S. domestic manufacturing, often driven by Buy America initiatives and tariff certainty.
And this is where the long-term thesis truly takes shape, I believe. This $35 million structural steel project they just won. It's specifically described as an initial win outside the cyclical oil and gas market.
Interesting.
It capitalizes on their capability for time-sensitive, heavy industrial fabrication, but for a different end market.
So why is GIFI uniquely positioned to benefit from these Buy America mandates? I mean, aren't there other fabricators?
Oh, sure, there are. But GIFI's advantage lies in a few areas. First, their existing capacity in the Gulf Coast region, highly strategic for both export and industrial development, is substantial.
Okay, location matters.
Definitely. Second, the push for tariffs means that large-scale industrial customers, think data centers or high-tech manufacturing plants, they need domestic partners. Partners who can guarantee quality and stick to a timeline without geopolitical risk.
Right, de-risking the supply chain.
Exactly. GIFI, with its deep history in high-spec structural work, becomes an immediate sort of vetted option when international supply chains become too risky or just too expensive due to tariffs. They're leveraging their domestic footprint as a competitive moat, essentially.
That context certainly frames the transition as, necessary and potentially high reward. And the market has already shown some faith, hasn't it? GIFI's total return over the last year has significantly outperformed the industrial sector ETF, the XLI.
It has. Investors are clearly betting on this pivot away from pure cyclicality. The challenge now is execution, and crucially for investors, timing the investment correctly to capture that next wave of upside without suffering too much through the Q3 drag.
Okay, so as we shift gears here, we absolutely must remind you that this next segment is strictly for intellectual curiosity. It's to explore the implications of the earnings call details. This is not financial advice.
Definitely not financial advice.
We're pitching an outrageous, maybe yet plausible trade idea derived from this specific strategic tension we've been discussing.
Right. The core challenge, as we've established, is navigating Q3. That's the integration pain period. But the balance sheet is rock solid with that $62.2 million cash position.
Yeah.
And the management narrative points to a very clear inflection point. It's tied to realizing that $35 million structural steel project revenue and getting ENGlobal stabilized in 2026.
So what's the structure of the bet? How would someone play this, hypothetically?
Okay, the trade idea is to structure a calendar spread that explicitly tries to capitalize on that expected short-term integration drag.
Yeah.
Use it to finance the long-term upside. You're essentially betting on management's stated timeline holding up.
How does that work in practice, though?
Okay, so an investor would sell a short-dated put spread, say one expiring sometime in Q3. You're basically monetizing the market's fear premium during this expected choppy integration phase.
Selling insurance against a big drop when things are supposed to be messy.
Exactly. Betting against a catastrophic collapse right when everyone expects them to bleed integration cash. You're using that short-term fear to generate immediate capital, the premium from selling the spread.
And then you immediately deploy those proceeds. You don't just keep the cash.
Immediately. You use the premium received from, monetizing the Q3 uncertainty to purchase long-dated calls. We're looking specifically at maybe Q1 or Q2 2026 expiry dates.
Buying upside, potential way out past the expected turnaround.
It's a targeted, potentially lower-cost bet on management hitting their 2026 profitability target for ENGlobal and the full utilization of that $35 million award starting in Q4. You are using the market's short-term doubt to acquire potentially inexpensive exposure to the 2026 strategic payoff.
Interesting structure. Leverages the timeline explicitly.
It does. So to wrap up, the core tension couldn't be clearer. GIFI is transforming. They're sacrificing near-term GAAP EPS by absorbing these integration losses today, but aiming to gain long-term durability and crucial diversification away from purely cyclical oil and gas fabrication tomorrow. The next 6 months are purely about proving that the execution is real.
Which brings us to a final provocative thought for you, the listener, to consider. Given management's commentary on the push for domestic supply chains, the tariff situation, will this recently awarded $35 million structural steel project, the one outside of their traditional energy base, will that set the definitive blueprint for how GIFI captures new non-oil and gas-related industrial growth opportunities over the next few years?
Good question to ponder.
Something to think about. Thank you for diving deep with us today.